Jessica Hewitt, and Jessica joined Brown Edwards in 2011 and has worked in a variety of areas. She has experience with corporations, partnerships, and fiduciary tax issues and is a director in our Newport News office. Jessica is well-versed in multi-state income taxation and serves on the firm's multi-state tax team. Manufacturers, dealerships, real estate, and construction industries are her niche focuses. Jessica graduated with a Master's of Science in Accounting from Liberty University and a Bachelor of Science in Business Administration from Christopher Newport University. She is a member of the American Institute of Certified Public Accountants, the Virginia Society of Certified Public Accountants, and treasurer of Windsor Castle Park Foundation.
Hello, everybody. Nice to be here with you all.
And next up is Corbin. Corbin has worked with not-for-profit, estate, and trust, closely held businesses, individual taxation, and planning for 21 years. She is currently a senior tax manager who serves on the practice development, estate and trust, and tax reform teams. She has been recognized as a super CPA by Virginia Business Magazine. Corbin graduated with a Bachelor of Business Administration in Accounting from Old Dominion University. Thank you so much for being here today, and I leave the floor to you.
All right. All right, Corbin, we still don't see your camera, but don't worry about that at all. I will advance the slides for you when we get to your parts. So,
thank you.
Welcome, everybody. I'm happy to be here with you today, and I am going to go through a lot about what's in the Build Back Better plan, and I'll just actually get to my agenda here. We're going to go what's in, what's out of the Build Back Better plan. I'm sure you have heard a lot about it, so I just want to clear up some misconceptions about what's still currently in the bill. Corbin will go through some credits, grants, incentives that are out there right now. Then I will go through some activity we're seeing in the state and local world, such as sales and use tax audits, and some things to think about for year end. And then we will wrap up with year-end considerations from a planning perspective for you all. Again, this Jessica and Corbin will be your dedicated team today. So what's in, what's out of the Build Back Better plan? We're expecting votes soon. It could be as early as today. I haven't really looked much today. I'm not sure there was much activity. We're still waiting on the Congressional Budget Office to issue a final score. So even if the House passes the bill, there are expected changes in the Senate to make up for that expected shortfall. So what's in the bill? For individual updates, there is going to be an expansion of the net investment income tax. So as a reminder, the net investment income tax is a 3.8% tax on your investment income, and your investment income includes your flow-through income from your company. When your AGI exceeds $250,000 if you're a joint filer, or $200,000 if you're a single filer. So what this change is going to do is it's going to expand net investment income tax to include active participation income from your flow-through entities. So currently, active income is not included in your net investment income tax. So if you're the owner of your company and you're actively working in it, you don't have to pay this 3.8% tax on that income. Now you're going to have to. So this is going to be a significant change for most all of our clients, and it's expected to raise $250 billion. So the next item is a high income surcharge, and this is for your really high net worth individuals. What it's going to do is impose a 5% surcharge on the modified adjusted gross income in excess of $10 million, $5 million if you're filing separate, and shockingly 200,000, very low number, for estates and trust. Then there's going to be an additional 3% surcharge for a total of 8% on income in excess of $25 million, 12.5 if you're filing separate, and 500 for estates and trust. Big takeaways here is these surcharges are going to apply to your regular income as well as your capital gains. So your capital gains could get up to almost a 30% rate in these cases if you're in these income levels. The surcharges kick in at much lower rates for estates and trusts. So a planning tip here would be if you're butting up against these income limits to get the income out of your trust, pass it out to the beneficiaries, let them pay the tax at their individual level versus it being trapped in the trust. So just some considerations to think about there. This is projected to raise about $230 billion. Next, we have the business loss limitations, which will be made permanent. Right now, the business loss limitations that were originally created by the Tax Cuts and Jobs Act were set to sunset in 2025, but they are now going to be made permanent. And what the business loss limitations are limiting your deductible business losses on your tax return for a given year to $250,000 if you're a single filer or $500,000 if you're married filing joint. You may not remember this, and it may not be a hot topic for you because the CARES Act delayed the implementation of this limit until 2021. So for 2018, 2019, 2020, we didn't have to worry about it. You may have worried about it in 2018, but you have since amended and removed that limitation from your return. So the Build Back Better is going to make it permanent. So planning tip here is that if you are expecting very large losses from your company and you are planning on capturing some capital gains to offset the loss, you may not be able to take as much of a loss as you think. So just keep that in mind. And the amounts are indexed for inflation. So the 2021 amounts are $262,000 for single filers and $524,000 for joint filers. There are some retirement plan restrictions put into the bill, and what these restrictions are going to do are effectively end and limit your backdoor Roth ability. So rolling 401ks or other employee plans to a Roth is no longer going to be available after 2021. And then Roth conversions will not be available to high income taxpayers after 2031. So if that is a tax planning strategy for you and you're in that high income taxpayer realm, you need to accomplish a lot of that before 2031. Lastly, and this is a hot topic for me, is the SALT cap is set to be raised. So the SALT cap is the $10,000 limitation on real estate and property tax that you can deduct on your return, as well as income tax, state income tax that you pay on Schedule A. You can only deduct up to $10,000 of that. So the Build Back Better plan says that they're going to increase it to $80,000 for the years 2021 through 2030. Now, this is a really contentious area and is expected to be limited by the Senate. So Bernie Sanders wants to set an income limit of around $400,000, while others are calling for $1 million income limit. If you're under those incomes, then you'll be able to use the full $80,000. If you're above those incomes, you're going to be stuck either at the $10,000 or with nothing at all. So I do expect to see some changes to this in the Senate. So what's out of the bill? And these are where a lot of people still are talking about these, thinking they're in the bill, but they're not. So an individual tax rate increase. So that going from the 37% back up to the 39.6 is the highest tax rate. That's out. The high income surcharge I talked about earlier is making up for most of the shortfall this would have left. So the rates are going to go back up in 2026 anyways. There really wasn't much of a need to take the political hit to increase rates across the board. That high income surcharge is taking care of most of that. The capital gain rate increase for high income earners from 20 to 25% was also taken out of the bill, and again, mostly replaced by the income that the surcharge is going to create. There were talks about changing and limiting the 199A deduction. That's your 20% deduction on your qualified business income. And so those were removed as well. Then there's been a ton of talk and a lot of planning about the estate tax exemptions. They're going to go back down to those $5 million levels. Well, those were removed from the bill. So the increased limits from the Tax Cuts and Jobs Act will expire after 2025, but the current $11 million is going to remain in place with the way the bill is written now. The elimination of valuation discounts and the use of grantor trusts as planning vehicles were also removed from the bill. So that's great news for a lot of our business owners. You can still use valuation discounts for valuing your shares. And then just a few other items that I'm not really going to get too much into, but want to make sure you're aware that they're not in there because they've been hot topics, is the mark to market on unrealized gains. That was struck, child independent care tax credits and dependent care FSAs. So the flexible spending accounts, those were also removed from the bill. Sorry, not a full question yet, Alexa. So from a corporate standpoint, what's in the bill? And this really isn't going to apply to most of you all, but I'll throw them out there. There's a book profits minimum tax of 15% for entities with $1 billion in profit. And this is going to be your applicable financial statement book profit that this minimum tax will be on. There's also going to be a 1% excise tax on stock buybacks for over $1 million after 2021. And then there's a slew of international provisions and changes that I'm not really going to go through here, but one of the biggest ones is including changes to the interest limitations. And then what's out of the bill? There's not going to be a corporate rate increase. So we're going to stay at this 21% for now. But what can we glean from a lot of the talk and what's in this bill? It's the push for more information reporting to the IRS. So your 1099Ks, the things that PayPal and MasterCard and Visa are spitting out to you, there's a decrease from $20,000 in 200 transactions to a flat $600. So now you sold something on Facebook Marketplace for $800 and you collected that payment through PayPal. PayPal's going to issue you a 1099K for that, and you're going to have to explain what it is on your tax return. May not have any taxable impact, but there's going to be a lot more information reported to the IRS. And then lastly, there's a lot of enhancements to the reporting requirements for digital assets. So your cryptocurrencies, the IRS is really cracking down on what can they do to better capture the buying and selling and use of cryptocurrencies and other digital assets. So we're going to see a lot more in that realm. So with that, Alexa, can you launch this polling question? What provisions are you most shocked, what provision are you most shocked was axed from the bill? Tax rate increase, the state exemptions, the 199A change, or mark to market?
Alrighty, the poll is active. All right, I am closing the poll now. Okay, can you see the results, Jessica, or do I need to read them back?
Can you read them back to me, please?
Yes, so the winner at 69% was tax rate increases. Second place was estate exemptions at 17%, and there was a tie at 7% for both 199A changes and mark to market.
So that's about what I expected. I think most people thought the individual tax rates would increase. And like I said, it just, from a political standpoint, there just wasn't too much there if they were going to revert back to those high levels anyway. And they were able to make up almost all of the money through that high income surcharge. So not surprised that you're shocked to see that was taken out. All right.
I have a question too, Jessica, if you have a second. It was, has this bill passed or is it still subject to the Senate vote?
Can you say that again?
Has this bill passed or is it still subject to the Senate vote?
Okay, so I checked at like 1:30 and there was no vote yet on this. So it hasn't passed the House yet. So this is the White House's framework that is out right now. So this is what we think is going to go through the House and then additional changes in the Senate. But like I said, it's not all paid for yet. So some of these things they've talked about could make their way back in there. But the big ticket items like the individual tax rate or capital gain rate increases, I don't see those creeping back in. Okay, Corbin, I am going to turn it over to you to talk about some credits.
So like most of you guys, we are in the midst of tax planning. We're looking for ways to either minimize taxes or monetize any credits, incentives, or deductions that may be available based on projects and operations. There is nothing that makes me happier than saving clients or potential clients money in the current year, but putting money back in your pocket that you've already had to spend, it makes me even happier. So while some of the tax strategies that we're going to discuss will be time sensitive and require some planning on your part, there are others that can be easily reviewed from previous periods, and the application process is quite simple. We're going to present a detailed discussion about the mechanics of the employee retention credit. We're going to refer to that as the ERC going forward, because it impacts almost every industry and business. Not to mention, there is a phenomenal potential for return on your investment in terms of time and money you spend to determine your qualification. In addition to the ERC, we're going to discuss the work opportunity credits, and I think this will tie into what Ken and Kent were talking about with your unskilled labor. And we are going to discuss the Virginia Enterprise Zone grants. We'll take some time to also look over the land preservation tax credits, research and development, 179D deduction, and historic tax credits. While the last three mentioned are pretty specific in qualification, many people in the construction industry can capitalize on these credits. And so to give you a little bit of background, the Employee Retention Credit was created by the CARES Act and has evolved with the passing of the Consolidated Appropriations Act, the American Rescue Plan, and most recently the Infrastructure Bill. The Infrastructure Investment and Jobs Act effectively eliminated the ERC, so it sunsetted about 3 months ahead of time, or ahead of when we expected. So we're going to focus on what you can do to capture the credits for both 2020 and 2021, and what to expect if you missed your October tax deposit, with the expectation that the credit was going to be available to you for the fourth quarter. Now, the exception to this would be wages that were paid with an eligible recovery startup business. So if you're going to consider the ERC, there are two different criteria that you have to look at. There's one set of rules for 2020 and another set of rules for 2021. And so when you're going through this process, keep in mind that you can potentially receive $5,000 in credit for each employee for 2020. This is calculated by taking 50% of the qualifying wages and healthcare cost, which is maxed at $10,000 per employee. For 2021, you could potentially save, get a credit of $7,000 per employee per quarter. And again, this is calculated by taking 70% of qualified wages and healthcare costs up to $10,000 for each quarter. So in other words, if you're looking at an employee with $30,000 of wages in quarters 1 through 3 of 2021, you could receive up to $21,000 for that employee. And if you multiply that by 5, 10, hundreds of employees, you can see that that can easily add up. So while, a lot of people don't want to go back through the headache of doing this, there's so much money on the table, it doesn't make sense not to do it. I'd also like to mention that the small employer definition, which was defined as 100 in 2020, was increased to 500 in 2021. So, much more generous provisions available to us. The nice thing about these credits is that most industries and businesses qualify. The definition is very broad. If you're in a trade or business, you'll likely fit the definition. This includes non-exempt organizations, but it does exclude government and sole proprietors' wages. Now, if you're a sole proprietor with wages, your employees can qualify, but not you. There are two tests that we have to look at to determine whether we meet. There was, for 2020, a lot of people, a lot of businesses qualified based on the fact that they were partially or completely affected by the government shutdown. Kind of as a side note, we're not seeing this much for 2021. Most likely your business is going to look at the significant decline in gross receipts. For 2020, a significant decline in gross receipts would require a 50% reduction in a calendar quarter from the comparable quarter in 2019. So you would look at your first or second quarter of 2019 versus your first or second quarter of 2020 and so on. When you're going through this analysis, you're going to want to pour your quarterly gross receipts for quarters 1 through 4 for 2020 and compare them to the respective quarters. You also want to go through that exercise for the first 3 quarters of 2021. For 2021, the qualifying percentage is reduced to 20% reduction, and so that's a lot easier to accomplish. There is a shift too from 20 to 21. When the program first came out, you qualified one time for 2020 and all quarters fell into that qualification process unless you had a significant recovery. For 2021, each quarter is going to stand alone. And by standalone, I mean you have to look at, say, for example, the first quarter of 2021 against the first quarter of 2019. Now, if you've had a 20% decrease, you're eligible for up to 70% of qualified wages, so basically $7,000 for each employee for each quarter. And so while there's a bit of work to it, it's definitely going to be worth the effort. For January 1 of 2021 to June 30th of 2021, this is not in the slides, but you can elect to use the immediately preceding quarter. So for example, instead of looking at quarter 1 of 2021 against quarter 1 of 2019, you can look at the preceding quarter. So if you had a 20% decrease from quarter 4 of 2020 to quarter 1 of 2021, you may apply. Say, for example, you've started a new company and your company didn't exist in 2019, you can compare your 2021 numbers to the same 2020 quarters to determine eligibility. We've received quite a few questions about the gross receipts test. You don't include interest, dividends, or rental income. But people were asking, you know, do we include the forgiveness of PPP or of the other grants? And the short answer is that you don't include the forgiveness of the PPP. It's important to note that your calculation should be consistent with your accounting method for your tax return. So if you're using cash basis for your tax return, then your gross receipts test, you're going to have to make sure that you're applying that consistently. We also got questions for my clients. Say there was a 3-month period, maybe May, June, July, that wasn't a natural quarter, but they had the decrease in those periods. That doesn't count. You have to have a calendar quarter. And looking at these credits, you may ask, what are qualified wages? And these are going to be the gross wages paid to an employee plus the qualified healthcare expenses. For 2020, the maximum was $10,000 per employee. And for 2021, the maximum is also $10,000 with the inclusion of your healthcare cost. Where you differ is the percentage of the credit. So the percentage for 2020, again, was 50% of $10,000. So the maximum you could get from any employee would be $5,000. For 2021, you can get $7,000 a quarter per quarter. We have a few planning considerations that you may want to keep in mind. First and foremost, it's not too late to get your credits. You know, we have the opportunity to go back and amend our 941 reports. Originally, it was said that if you receive the PPP funds that you would not qualify. As an employer, you can still qualify even if you receive the first or second rounds of the PPP funds. Now, what you'll need to do is to not double dip. So say, for example, you received in the first quarter PPP funds, and used 8 weeks of wages to get your forgiveness, to have your forgiveness. So when you're looking at your employee retention credits, you need to pick up in week 9. So it's basically just asking you not to use the same credits. Affiliation rules do apply if you have a parent subsidiary group or brother sister relationship. You may have to consider this at the aggregate level. It's at this point that I would encourage you, if you are doing these credits in-house, to at least reach out to a tax advisor just to make sure that you have properly qualified, because you have to do this application at the aggregate level and basically dole out the credits to the other agencies. As a reminder, wages paid to owners and related parties are not considered eligible wages. So say you have a corporation, S corporation, and you, your wife, and your brother Ted are, you know, employees. These 3 have to be excluded from qualified wages, but the other wages will qualify. Because of the early sunset that we weren't necessarily expecting or didn't necessarily plan for, if you did not deposit your October tax deposit, considering that you would be in anticipation of qualifying for the 4th quarter, I would encourage you to go ahead and get that deposit in. If there is a penalty notice, likely some correspondence would, you know, get you out of that penalty, but that is something that planning wise may be different for you. So now we're going to look at a polling question and ask, you know, have you reviewed your gross receipts for 2020 and 2021?
And
I've launched
just
the poll question.
for
Yeah.
everybody listening here, I don't know what provision in any bill is going to pay for all of these credits, but they're huge. So go after them if you can.
Well, and honestly, the first thing that we're going to do in our process, when you bring your work in for tax planning or even at year end, the first thing we're going to ask you to do is to go ahead and run those numbers for your gross receipts, just so that you have determined whether or not you qualify, because you certainly do not want to miss this. These credits have you know, been in the tens of $1,000s and in excess of $1 million for some of our clients. Now, what I will warn you about is that they are not going to be received promptly. I mean, if you're filing amended returns for 2020, I mean, you may be looking at 6 to 9 months before you receive the refunds. If you look at 2021 in the current year, you're probably at a minimum still looking at 3 to 4 months. So while it's a great opportunity, it's not something that you're going to file the report and then you're going to have money in your bank account a month later. So, you know, just when you're doing your planning, make sure that that's what we know. So I'm encouraged to see that you know, 2/3 of the businesses have reviewed. For those that haven't, I would encourage you to do so. If you're comfortable doing it yourself, you know, go through the exercise of looking at those quarterly amounts. If not, just reach out to your tax preparer, or in some cases, you know, your payroll provider may have reports. You know, I know ADP in particular has reports specific for these credits. So
And
really,
Corbin, I just want to do a quick time check before you go on. We have 15 minutes left.
okay, yeah, everything else is quicker. Okay, so for the work opportunity tax credits, this ties into, you know, Ken's poll where we said 42% of young workers don't have the skills to fill the employment gap. I think it was Kent that mentioned something about the training that was available to workers that have been incarcerated. And work opportunity credits, I think, are often overlooked. And while this credit might not apply to every business, I did want to mention it because one of the targeted groups is individuals that have experienced long-term unemployment, and coming out of the environment that we've been in, more workers may qualify than had previously done so in the past. It might not be as lucrative of earned employee retention credit, but it does reduce the risk of an employer taking the chance to train an employee. You know, maybe they have some background issues or coming back into the workforce after unemployment. Generally speaking, you can receive up to $2,400 for an individual, $9,600 for a qualified veteran. To receive the maximum credit, the employee has to work for at least 400 hours. If they're 120 hours and less than 400 hours, the benefits reduced from 40% to 25% of eligible wages. But basically, it's a win-win. I would encourage you to check with your localities to see if you're in an empowerment or rural renewal county, because these residents in these zones also qualify. So if you're looking for job candidates in this group, the American Job Centers and partnering agencies can assist you. Here in Virginia, it's the VEC. In North Carolina, it's the North Carolina Department of Commerce, and then in Tennessee, it's Department of Labor and Workforce Development. So, like I said, I just wanted to make you aware that this is available. There is a form that has to be filled out. If you have a job applicant, it's basically a pre-screening notice, and you want to have them sign this on before their start date. You have 28 days to submit this to the agency in the state where the business is located, and once you receive the certification, you can file for the credit. So again, you know, is this something that your company is utilizing? We have a poll question.
I've just launched the poll question. Okay, I'm closing the poll now.
So I'm actually encouraged by the fact that 26% have actually utilized the work opportunity tax credit. Like I said, especially when you're looking at unskilled labor or, you know, first year employees that may need some training, it just takes some of the risk out of you as an employer training these folks, because there is some incentive to do so. So one of, now this is not going to apply to our folks joining in from North Carolina or Tennessee, but Virginia has areas designated as enterprise zones. And part of the enterprise zone program is, you know, different areas may qualify, you know, because of unemployment or other factors. But if you look at the map, you'll see there are a lot of areas that we service, especially with Brown Edwards. A lot of our clients fall into these areas. There are two very good grants that are available. There is a job creation grant and a real property investment grant. And we'll talk a little bit first about the job creation grant. First thing that you want to do is just look at your business and the GIS map and look at the overlay to see if you fall into the enterprise zone. I would encourage you, no matter what business or what locality you're in, is to get acquainted with your EDA or IDA directors, with your chamber. A lot of times they're administering these programs or act as a liaison. And so they're able to give you some feedback in terms of what you may be eligible for, because if you're in this Virginia enterprise zone, for example, the localities also have some incentives with reduced personal property taxes, low interest loans. So it always makes sense just to reach out to the folks that are in economic development in your area. But for the job creation grant, you have to be located in the enterprise zone, and you have to create 4 net new full-time jobs over the base year. Now, the nice thing about this program is that you have the opportunity to choose one of 2 base years, either the prior year or 2 years prior. So say you started your business in 2020 or relocated your business into an enterprise zone in 2020 and they're not current employees, your base year is 0. And so this grant period goes for 5 years. And you have to meet, have to be at least 175% of federal minimum wage. If you're in a high unemployment area, that's only 150%. And you have to cover 50% of the employee's health insurance. There are certain businesses that don't qualify. It's certainly worth looking, you know, a lot of construction industry jobs do. And so you have a 5-year grant period, and you can have a grant for anywhere from $500 to $800 per employee per year for 5 years. And so we have a lot of businesses that take advantage of this. The nice thing is if you have fewer than 100 jobs, and I think it's 25 net new jobs, you don't have to have an attestation from a CPA. This is something that you can do in-house. So if you only had 10 jobs created, I mean, that's $5,000 over a 5-year period. I mean, that's $25,000 in your pocket just from going through the process of the application. Now, what I will say is the job creation grants are time sensitive. So for example, for December 31st of 2021, the applications are due on April 1st. So you want to make sure that if you do need attestation that you're reaching out to someone that is licensed in Virginia to go ahead and get this grant application started for you. Now we moving on to the real property investment grant qualification. So this is a good program if you are rehabilitating or expanding an existing structure, or if you're building a new structure. So say you have a project of, again, you have to be located in the enterprise zone. For rehabilitation and expansion projects, your improvements have to exceed $100,000 to qualify. For new construction, this amount, the threshold is $500,000. If you have solar projects, you have to have at least $50,000. Investments in machines, tools, and business personal property aren't considered in this calculation. If you go on the Virginia Enterprise Zone website, there is or if you want to reach out to us, there are a list of costs that qualify. So if you have this program, you can get a grant from anywhere from $100,000 to $200,000. Now, the real property investment grant is prorated. The job creation grant is funded at 100%, and then the real property investment grants are funded based on a percentage. So this has ranged since I've been doing them anywhere from 69 to 82%. But if you've got a project that you're going to have a certificate of occupancy or a third-party inspection that finalizes in 2021, it's worth asking the question, do I qualify? So then we're going to go, again, if you have any questions about these grant programs, Jessica and I both have our email addresses. I don't think we need that poll question.
Yeah, I think I launched the last one if you can. Alexa, I'm not sure we actually need it though.
Oh, okay.
The poll question has been launched.
So are you prepared for a sales and use tax audit, which has nothing to do with what Corbin just talked about, but is a lead into what we're going to talk about next.
Okay. 82% yes.
Okay, well, that's promising. See if we get back on this screen here. All right, so in our last couple minutes, what I want to talk about is what we're seeing throughout, and this is mostly in Virginia. We're seeing a lot of activity in the sales and use tax area, especially in the construction space. And intercompany transactions have been of particular interest of our auditors. So one example of where we see people getting hurt in these audits is where overhead costs are being allocated between related companies. So you have your operating company and you have your equipment company, and you're allocating your overhead costs between the two. that's going to be deemed a rental of equipment and be charged sales tax. You're probably not doing that already. It's going to be part of a report. We've also seen instances recently where an owner draw is included in an audit extrapolation. So the owner uses your corporate account to purchase a personal item and is not charged the sales tax at the point of sale. So although the company properly accounts for the expense within the owner draw account and not a regular expense of the company, the owner was not exempt from sales tax. He should have paid it. So the auditors are taking this and putting it as an error, and thus it's extrapolated into the audit results. So please pay attention to those things because they're getting very aggressive within these audits. So what I want to remind you of is sales and use tax is a fiduciary tax, means you as an owner or a corporate officer is responsible for any unpaid taxes. So just be aware of that. Compliance is your responsibility. If a vendor has charged the tax incorrectly or not at all, you are responsible for filing the use tax return and remitting the tax. So what do you do now? What are the best practices that you can put into place? Because I hope I scared you just a little bit because we're just seeing so much activity. So what you can do, treat all sales as fully taxable and provide the invoices to customers that way. Then if the customer believes they're exempt, they must provide you with their exemption certificate at that time before you revise the invoice. So that's on the sales side. If you're purchasing, have somebody trained to review your purchase orders to make sure that the invoices include the sales tax appropriately. And if they don't, to either reach back out to that company and have them revise it, or go ahead and create your use tax return and file it that way. Review and properly maintain completed exemption certificates. Make sure the name is filled out completely. Is it signed? And have the certificate dated prior to or the same date as the date of the transaction. Review your intercompany activity. Make sure that, well, all leases of equipment that are only the equipment require sales tax. So review those, make sure you're charging the sales tax on it. And if you're not, talk to us, talk to your service provider about how you can restructure your transactions from intercompany to avoid the sales tax. And then look at the state published sampling guides that are available for audits to familiarize yourself for what would be looked at during an audit, what would be requested. These are really painful to look at, but they should help you set up policies and procedures to go forward. Now, a little bit about income tax right now. PTE elections, you may have heard a lot about these. What a PTE election is a pass-through entity tax election. And what it effectively does is circumvents the $10,000 SALT cap. It allows you to deduct your state taxes for your individuals on the corporate level. What I want to make sure you know is that these are not available in Virginia or West Virginia. They don't have laws on the books for it. And currently, I don't see any activity in that area. North Carolina does have a proposal to implement a PTE tax election, but it currently hasn't gone through. If you're filing in a bunch of different states and you file composite currently, but they have now implemented a PTE election, you should discuss with your service provider what the cost benefit is to switching over to a PTE election versus a composite tax. But again, what this effectively does is lets you deduct your state taxes at the corporate level versus it being a distribution from the company. And then some PPP implications. If you received round 2 of PPP, this is just a reminder that 100% of it's going to be taxable in Virginia. Currently, only expenses incurred in 2020 were subject to that $100,000 carve out. And so if you receive PPP round 1 in 2021, that is also the case. It will be 100% taxable in Virginia. Tennessee and West Virginia, you got the benefit of it being non-taxable and deductible. And then just quick notes on a few things that Youngkin has mentioned that he would like to do within the state tax world is remove the 2% grocery sales tax, double the standard deduction, and have a one-time rebate payment of $300 to $600 depending on your filing status. But just want to let you know that those are a few things he's talked about, not that they'll have any traction, but are things he would like to do.